Welcome to follow this time first quarter 2014 interim reporting of Cramo PLC. My name is Vesa Koivula and I'm acting as a CEO, and I have here with me our CFO Martti Ala-Härkönen. In the material you will find the content of the presentation. It's pretty much following our previous years and quarters presentations. The main thing is of course to give you highlights of our fresh reporting of this morning. So welcome. First of all, it looks like the Eurozone economies are expected to resume growth during this year 2014. And growth is expected particularly in the second half of the year. Even though the Ukrainian crisis has brought uncertainty to growth expectations, the general expectation of economic revival in Europe this year remains anyway unchanged so far. After a challenging start of the year, our performance started to improve during the March month. Because of mild winter in January and February, the demand for the heating services was low in Nordic countries, but on the other hand, construction got off to a good start already in March. So I would say slightly earlier than usually. Considering the market situation, the result was good in Finland and Sweden, but in order to ensure positive development in Sweden, we reduced our cost base in order to further enhance the efficiency of our operation in the Swedish market. The cost savings are expected to have a visible effect during the second quarter this year. The result improved also in Norway, where the costs were also reduced. In Central Europe, the demand itself developed favorably and the transition of our program progressed as planned, but the result was still negative. In Eastern Europe, sales and profit developed as expected, except the joint venture Fortrend. So Ukrainian crisis decreased construction and the demand of rental services in Ukraine, of course, and Russian area. But the company Fortrend responded by rapidly adjusting its costs and decreasing also its level of investments at the moment. So overall, our result was result for the first quarter did not entirely meet our expectations. But anyway, I do believe that our group will reach its full year performance goals, and I will highlight more about the outlook in the coming presentation. But then if we see some of the figures and highlights for the Q1, so sales was now 140.3 million, so it is down 5.6% from last year. But the change in local currencies and in comparable figures, excluding the restructuring in Russia last year, so it was slight positive sales growth. Whereas EBITDA 4.4 million was down from last year, and the margin was 3.1% for the first quarter, comparing to last year 4.3. Earnings per share minus 0.03, so somewhat below last year. Return on equity, on the contrary, that on a rolling 12 months basis is now increasing, so it was 8.5% comparing to 6.9% last year. Cash flow, our investments was a negative in the first quarter, minus 10.7 but we expect that we will continue to generate a strong cash flow in the coming quarters. Of course, this is the time of the year that most of the investments are made, and that of course have impact also in the cash flow. Why not also the acquisitions made, which I will talk about later on. Gearing, it's on a comfortable level at the moment, 76.3%, a little bit higher than last year, but we could expect that it will be even lower when we go forward this year if we do not do any major acquisitions, which we are not aiming to do, but I will come back to that as well. And of course, some highlights, I will talk more about these later on. Some highlights are that we made now one very good strategic acquisition in Germany, and also one strategic important acquisition in Finland. But then continuing about the first economic sentiment, here we see the latest European Commission estimates. It's clear that at the moment it seems that the sentiment is already on a, let's say, good level, in any way above the long-term average in Sweden, Germany and Denmark. Whereas Poland is below, but the trend is quite positive. And we could expect that this will continue for Poland. But Finland is here, as we know, quite negative still, and even was worsening in the late months. So Finland is one of the negative countries what comes to the economic sentiment at the moment for us. And this is reflected to construction confidence, so that the most stable here, Germany, which is not any surprise, clearly above the long-term average also. But then the other countries which are below the long-term average, they are Sweden, Denmark and Poland actually also. So construction has been now picking up already in the Polish market. But also here we see that negative situation with the Finnish construction, which is clearly still below the long-term average. And this is again then summarized in the construction outlook estimates of different countries. Finland, as we know, this is no change there. So in Finland, expectation is that residential construction remains low. I would say that maybe the only sector expected to grow at the moment is renovation. With the note that when expectation is higher for the next year, so that means that during the second quarter we expect that the construction start to improve also in Finland. For Sweden, there is a change to better what comes to their local byggnadsindustry estimate, which is now plus 5%, which is a very good and high outlook figure. So it is up from 3% from the previous estimate. Very much driven improvement in residential. Why not also renovation is growing, and maybe all the other sectors are well growing in Sweden, except the non-residential, which is remaining maybe flat. So this is of course very positive thing for construction, and positive for us if this estimate holds. Norway continuously 3.6%, a little bit mixed. There are certain signals that now during April that the residential has been somewhat, at least slightly picking up, but Anyway, the total construction expected to grow clearly. Same goes for Denmark. Residential picking up, also non-residential improving, and renovation also growing. For Baltic countries, slight minus. This means that somewhat slight decrease in Latvia and Estonian markets, but then increase in Lithuania. Poland, as I referred already before, have quite strong and positive outlook at the moment after very negative last year. Czech and Slovakia expected still this year be minus. Russia, here this is Euroconstruct estimate. One note is that this does not consider any impact out of Ukrainian crisis. So this figure is I would say quite uncertain at the moment. For Germany, very good expectation for this and next year as well. So overall, if this is the right outlook, this is good for the rental industry. But of course, we have to now, as always, follow up this by month and by quarter. And then finally, how this reflects to the outlook of our own industry. This is done, this inquiry once a quarter. So in the first quarter, the current business condition estimate inside our own industry was increasing and improving, as it has been now doing already during last year, the whole year, and now it continues. So within the industry, also the trust for the improving is quite high at the moment. Okay, one comment more that there is big deviation by area in Europe, and luckily we are in those areas which have the good continued positive outlook at the moment for growing. And finally, summarizing this by country, so this is expected rental market development. For this year, it shows that the highest growth expected in UK, which is not our market, but the highest growth expected in our markets actually in Germany. But good growth also expected in other markets. This shows even Finnish market positive, which I would make a small note that this may be a too positive view here. Whereas then for next year, pretty much the same picture. All areas expected to have good growth. Okay, and now I leave word for Martti, please.
Thank you, Vesa. The heading of our first quarter report says performance started improving at the end of the quarter. I want to start with that because when we were thinking beforehand how we should best describe the quarter, this is what we came up with. Because at the end of the quarter, nevertheless, there was clear positivism regarding the business. So after difficult January, February, like Vesa already explained, our markets turned towards the better clearly in March. But let's start looking more closely at the results, starting with sales. In the first quarter of 2014, our sales totaled 140.3 million euros. There is a decrease of 5.6% against year earlier, when our sales were 148.5. The weakening of the Swedish krona and the Norwegian krona had an adverse effect on our sales. So when we're looking at the sales growth in local currencies, the decrease was less, only 1.8%. And furthermore, it's worth noting, what is notable here is that excluding the restructuring in Russia, our sales actually increased in local currencies by plus 0.8%. But of course, 0.8% overall, one could think it's not yet, we are not yet in a fully growth mode of the market, but the change in March was nevertheless very visible. And looking more on the further into what happened in the first quarter, so this year we of course had a mild winter overall in Europe, but for the Nordic countries it was also so mild that our heating equipment actually in the Nordics was basically out just for about 3 weeks, when normally it's out for about 2.5 months. And heating equipment and heating solutions, they are an important seasonal product, and that had an adverse effect on our sales in the Nordics and affecting also profitability. So on the other hand, when we come to March, on a positive note is that the mild winter clearly accelerated the start of construction project somewhat earlier than usual. And furthermore, on a positive note, if we go geographically south from the Nordic countries, in Central Europe and Eastern Europe, there the mild winter had overall a positive effect. And that you can also see when looking at the segments. So when we had in the first quarter negative growth, or at best segment-wise, our sales growth was on par in local currencies with the last year, like in Sweden. But in euro-based, we were all in the negative in the Nordics. In Central Europe, our sales growth was 16.9%. And also in Eastern Europe, if you exclude Russia, we had 3.5% growth. So that anyway reflects also the milder winter for the Central Europe. As for Russia, on the other hand, if we take that into account in Eastern Europe, there the Ukrainian crisis clearly impacted also sales in a negative way. Next, looking at EBITDA, in the first quarter, EBITDA amounted to 4.4 million, or as a percentage of sales, 3.1% versus 4.3% earlier. Like I said earlier, the result was weakened by the modest demand in January and February, after which the market picked up and the performance improved in March. What is notable, looking at the gap of 2 million, that actually 1.5 million of the EBITDA gap is explained by the Russian operations, including Fortrend. Last year, we had exceptionally high profitability for our Russian business, especially in January, February, and when we look at the quarter as a whole for Russia, including Fortrend, this year our EBITDA was 1.5 million lower than in the previous year in the quarter. Segment-wise, nevertheless, and considering the market situation, our result was good in Finland and Sweden, with even improving profitability in Finland. In Norway, we also improved our profitability, whereas our transformation plan was still negatively impacting profitability in Central Europe. There we, for example, took our harmonized rental system into use in the first quarter, which also resulted in non-recurring costs. But they have been treated as operational non-recurring costs, and also the transformation program. But as visible from the high sales growth, we do have good expectations on Central Europe and Germany going forward. And also this will be backed by the entry into the modular space business in April. But nevertheless, the EBITDA for Central Europe was 4.6 million negative. So basically Russia and Central Europe were the two negatives. In terms of other segments, there was rather positive, also in many segments, positive developments. However, as Vesa already also told, in order to ensure positive performance development going forward, we completed cost reductions and reorganization in Sweden and Norway in the first quarter. I like to say that the cost for all these measures is included in the first quarter results, so we do not expect any one-off costs from those going forward. And Vesa will later outline, when reviewing the segments, these cost reductions in more detail. So as a final note, looking at the EBITDA performance in the first quarter, I think the main issue is anyway that our performance started improving at the end of the quarter, and this gives, of course, good confidence, and looking at our full year result and full year performance goals, they are all intact despite the Q1 result. Next, looking at our earnings performance per share, our diluted EPS improved to, or a small improvement to 3 cents negative, whereas 4 cents negative last year. Perhaps worth noting a few words on cost lines below EBITDA. In the first quarter, our net financial cost continued to improve. They were 3.4 million versus 4 million a year earlier, so there was an improvement of 15%. And our effective tax rate was at the same level as last year. However, on a comparable earnings per share basis, last year the comparable EPS was plus 1 cent, because last year we also had non-recurring impairment related to the formation of Fortrent and reorganization expenses related to our business acquisition in Norway. And what one can also see from this picture overall, that seasonally the first quarter is typically and has been always the worst for the group, which is also visible from the EPS graph. Then looking at return on equity on a rolling 12 months basis at the end of the first quarter, our return on equity ROE continued to improve to 8.5% versus 6.9% at the end of first quarter last year and versus 8.3% at the end of Q4 of last year. And I want to highlight here that all the efforts continue to reach the financial target level of over 12% of ROE over the cycle. And looking also forward to the second quarter of 2014, we will also get now some benefit from the fact that last year in April we paid down or paid out or redeemed our hybrid capital, which was also part of the equity. So in terms of the ROE calculation, where you have in the denominator the average of the equity for the last year quarter and this year's quarter, when we go into Q2, we don't anymore have the hybrid capital in the calculation. This should help, of course, also our return on equity figure. Next, looking at our capital expenditure. In the first quarter of this year, the organic gross capex amounted to 27.3 million versus 15 million a year earlier, so there's an organic growth of 82%. And then it's next worth highlighting, where do we invest in the growth? First, product-wise, we have continued to support our modular space business in particular. So 44% of the capex was related to modular space. And business segment-wise, there are clearly two business segments above others. It's both Central Europe and Sweden. And the reasons are that we see an improved outlook in Sweden and in Central Europe. Like I said, we are continuing the rollout of our what we call the Cramo rental concept and the transformation program, which is now in I would say in a very, very good pace in that market. So just looking at the business segment of Central Europe in the first quarter, the capex was 10.1 million as an example versus 4.2 million a year earlier. And at the end of the first quarter, the group's investment commitments amounted to 36 million versus 17.2 million a year earlier. There is also quite a clear increase year on year. However, with the majority again being related to the acquisition of modular space. So in modular space, we do only invest when we have contracts at hand. So it follows the market demand. But one can, when one analyzes the investment commitments, so they of course give guidance towards that we are currently heading towards somewhat higher fleet capex for 2014 compared to 2013. And why, one could ask why this is so, and the answer is clearly because of the improved outlook. However, I also want to highlight always before we invest in new equipment, we always looking for idle equipment wherever in the group. So the new investment always comes as the last issue in the line. However, I do not expect our capex to be materially higher than in 13 and 14. So it still takes into account the gradual recovery in the markets. In terms of our cash flow in the first quarter, our cash flow from operations was 8.1 million. There's a decrease over the previous year, and like I said in the Q4 reporting, and as we also then were reporting, cash flow from operations was negatively impacted by a residual tax decision of 9.7 million euros in Finland, which we paid out in the first quarter. According to the decision, the interest income from our financing company in Belgium should have been taxed in Finland, although we have already paid the taxes in Belgium. And we, as well as all our tax advisors, consider the decision to be fully unfounded, and we have appealed on the case. And this is important to highlight here that without the impact of the 9.7 million cash flow from operations was at the previous year's level. Cash flow after investments improved to minus 10.7 versus minus 18.9. There is of course always the impact of the residual tax decision. Finally, it's perhaps worth highlighting, which one can see also here over the past few years, that the group has had extremely strong cash flow over the last 5 years. And this year, like we said also after the Q4 reporting, I also await very good cash flow. But it will be somewhat different to the previous years in the fact because of the timing of the investments, somewhat higher dividends in the second quarter, some acquisitions. So I await good cash flow after investments, especially in the fourth quarter of this year. But when we look for the full year, our expectations for the full year are positive. Finally, the company continues to have a strong capital structure. At the end of the first quarter, our net interest-bearing debt was 375 million versus 365 in the first quarter of last year, or at the end of last year. And the net gearing was at 76.3%. And as we can see here, the gearing is meeting well the financial target level of maximum 100%. So all in all, the group's capital structure and financial position, they do enable the group well to pursue its operations and development plans going forward. And before handing over to Vesa, I want to highlight just two issues. First, we are at the moment undergoing the strategic planning period for the group for the period 14 to 16. And we, of course, there are new issues that we are considering because we are waiting the markets to turn towards the better. So it's also an issue how to best capture those opportunities and the growth which we feel is also awaiting us in the next few years. And our plan is that we will have a Capital Markets Day on September 9, when we will also tell more of the new strategy. And furthermore, in 2014, like I have said earlier, all the group's initiatives and projects, they are targeted at further value creation and further profitable growth. And Vesa will outline that more in the last section of our report. So I will here hand over back to Vesa.
All right, let's continue and review different business segments, starting from Finland. For Finland, the sales, as is seen here, was down somewhat, minus 1.2% from last year first quarter. But we were able to keep a very good profitability level. And this is, of course, a very positive sign of a strong operation, knowing that, as I showed in the beginning, that the market outlook has been and is still very weak in Finland. So our EBITDA was up 21% from last year and giving already in Q1 12.3% margin. We can see also here in this slide the rolling 12-month EBITDA margin development, which shows that now rolling 12-month margin in Finland is 19.4%. Anyway, the weak demand affected sales in Finland. But here we saw also that the daily sales started to improve already during the month of March. So market situation as such, of course, it's tough, and the construction activity remained pretty weak still. The one sector which is positive is continuous the renovation, and for us modular space segment as such, where we have continuously a good order backlog, and that is showing very good stability going forward. And I'm happy that we were able now to also support the Finnish operation with the acquisition. I will highlight that more in the coming slides. For Sweden, the sales decreased 4.1% in the first quarter, but in local currency the sales was flat, so 69.9 million euros. EBITDA 9.1, giving 13.1% margin, somewhat less than last year. If we analyze also here the total quarter, so the weak months really were January and February, and then the picking up of the sales and daily sales started during the months, exactly the same like in Finland. Anyhow, we decided during the quarter to go through reduction in our cost base and implement some changes in the depot network, which means basically that we are closing some of the smallest depots. We are closing 10 depots, which means that also we decrease some 40 temporary or hired people. This is a good let's say time to do this, and of course it will support our operation in coming quarters. Actually, we estimate that the results of this or figures is visible already in the second quarter, or during the second quarter at least. This means small adjustment on our structure, but I would say that overall, of course, this business is such that we are looking for the optimum structure all the time. So that's why this is no dramatic change, but gives us more efficiency, and definitely we are not going to lose sales with this, but make us more efficient when using the assets and the fleet. And already in the beginning I showed the strong outlook for Sweden, so there is now good reason to expect that the next quarters will be strong for the Swedish operation. Area-wise, of course, Stockholm is the strongest part of our business continuously, and that was the case in Q1. Southern part, I have commented earlier that Malmö has been the weakest area. Now we saw a slight improvement already in that area, and Gothenburg, the southern part, there also slight, let's say, improvement, but that was but maybe a little bit under our expectations. But the most negative area at the moment in the business has been actually the northern part, where there has been certain project delays, and at the moment in Q1 the north was not performing as expected. Pricing, no, I would say special issues within pricing. Of course, Q1 is very tough pricing and market environment. That means that then also price competition is hard. But I would describe at the moment that we have stable situation, and we are now following carefully how the market is now picking up, and then later on considering if there is room for even price increases. And then if we say take Norway, so here the sales decreased 11.9%. Again, in local currencies, decrease was some 1%. We were able to generate EBITDA 1.6 million, giving a 7.7% margin. So in the reported figures, this is good development from last year. But here, same note than Martti already made, that we had here some non-recurring items which improved the result. And basically those were related with the outsourcing case in Lambertson, where we had booked certain earn-out provision. And now strategically we are satisfied with the outsourcing deal, and it is giving us a good strength, but the sales is not generating as high sales as was expected, and that's why we were actually we had to do also this reversal of this provision. So overall, market is positive at the moment, and we continue to streamline our operation, which we made already also during first quarter. That meant also that we closed down a couple of depots during Q1. Going to Denmark, here the sales was clearly down from last year, 13%. EBITDA also down. Here I make a note that these figures are not fully comparable. So last year there was a big impact of a sales case for Copenhagen Metro. So that's why the comparable figure is improved from the, say, operational EBITDA last year. That of course does not help our performance for this year, but this is a certain explanation. Overall, we are now following our plans there after big restructuring earlier, and looking for the next step, especially when now it seems that the construction growth has started on the market. Our rolling 12 months EBITDA, of course, it's still negative after this quarter, but we expect that with fulfilling our plans now going to stronger quarters, we can continue to improve EBITDA quarterly and of course the rolling 12 months EBITDA as well. One thing to mention here is that our modular space is also here developing well, and there are in planning now also very big projects for the Danish in the Danish construction, and one of the big ones is the Copenhagen Metro, which is already ongoing. But there will be some new big projects in the coming years. For Central Europe, our sales increase was, I would say, on a good level, 16.9%. And as commented earlier, the German market was developing quite okay in the first quarter. This shows this sales growth that those actions which we are doing, and on the other hand, the mild winter, which was also easing the rental of construction machines, those are working. But the fact is that now, so far, we have opened 6 new access hubs in different parts of the country. This year we are planning to open 5 more. So far we have opened only 2 tools depots, which will continue, that we will bring more investments in tools and open further new depots. So this is a process which is now ongoing, and seeing now the figures, of course, it's not yet here. So as we have reported that our transition program is now proceeding as planned, and of course the aim is that then it starts generating us still more sales and especially the profit. So this is now continuing, and even though the result was negative, this transition program continues. One note here is that, of course, at the same time when now making this change in the organization and the company, we have also implemented during Q1 the new ERP system, which cost us extra costs, which we are not reporting here, but the costs have been booked there. And also overall this transition program, changing people, hiring new people, establishing the sales organization has of course cost us also one-off costs, which we are in the figures, but we have not been reporting separately. As a sign of continuing, let's say, improvement planning here, we also made one acquisition, CS Raum, which is in the field of modular space, and the aim is here also to make our revenue and profit performance more stable during the winter months. I will come back to this CS Raum acquisition later on. Eastern Europe, sales down clearly. Of course, this is the main reason is that we made this arrangement with Ramirent establishing Fortrent last year, but excluding these or in comparable operational figures, actually the sales was somewhat improving, 3.5%. EBITDA was minus 1.4, referring to Martti's comments already. So there is for some 1.5 million impact because of these Russian operations. This means that other European countries, meaning Baltic, Poland, Czech and Slovakia, there the profitability improved against last year. Sales was a little bit increasing, and also we were able slightly to improve the profitability. And maybe Poland is the biggest and most interesting country going forward, because now there seems to be a change towards positive growth on the construction market, and also we have been now performing there so that the profit has been improving from last year. Okay, then we could go to the next section and see some slides related to our growth plans and priority areas for this year. If we start for how we drive more customer and sales excellence, I just highlight some of our, let's say, practical actions which are ongoing this year. First of all, pricing. As I have commented earlier, we are one of the first companies in Europe now implementing already dynamic pricing. That's also already operational in Finland, in Sweden first, and now also in Finland, Denmark, and it continues so that gradually it will be used in all the countries. We have also implemented new CRM system. Then how to maintain the cost base. Good examples are what we are doing now, I would say very quickly when the decisions have been made, cost reductions and reorganization in Sweden, and structural changes in Norway. We have also continued, and we will continue a big project where we seek much more efficiency in our purchasing and sourcing processes. We are, as Martti commented this year, focusing to somewhat higher capex. Not focusing, but it seems that the operations are now growing so that we must do some growth investments as well. And basically that means that Germany and Sweden will be the areas where the growth investments will be made. And as a product modular space, it's clear that there we have so good position, and we are now expanding modular space business from Nordic countries now towards Central Europe as well. And a clear sign of that is now this acquisition, and also that we have signed one big contract already in Germany. We are implementing our new ERP system now. It's already used in the most parts of the group, but still to continue in the smaller countries. And one of the most important practical issues which we are going through is that we implement so-called performance management system. Finland is a good example. We have implemented this system already about 1.5 years ago, and it shows its strength now when the market is weak and we are performing very well. This is very good support and sign that these strategic projects are really improving our performance. And then finally, now we can disclose that we are looking for certain kind of bolt-on acquisitions which could strengthen us locally in different countries and different areas. And now we made this in Finland and Germany. With this slide, which I have shown some quarters back, want to highlight the fun feature of not only Cramo but the rental industry, the high operational leverage when the market starts to grow. So there are made a few basic assumptions. One is that this does not count increase in or the increase in sales is generated with the existing fleet and existing cost base, and that this does not count any price increases. So in principle, if our gross margin is 65%, indirect cost ratio around 40%, and capital cost ratio 14%, so our EBITDA margin 12%. This gives as a leverage multiple, gross margin divided by EBITDA, leverage multiple 5.4. Assuming that now we are generating 5% growth, our cost-based fleet remains the same, no price increases, not either reductions. So we should be able to generate 5.4 times more EBITDA. And this is an interesting feature and strength for us just when the markets are really turning to more positive and growth. That's why I wanted to show this once more. Then I have promised a few words about these acquisitions. They are very good examples of good acquisitions which are fully in line with our strategy and strengthening us locally. OptiRent, why this field of operation? In 2012, the total value of construction machinery usage and rental in infrastructure construction, so infrastructure construction, was about 1.8 billion euros. How much was then made as rental? It was only 61 million euros. So penetration in that sector is really low. So that is why it is interesting for us to strengthen this field of operation. And now we have acquired a strong company which is in a market leader in the category of earth moving equipment under 10 tons, mini excavators, small excavators, etc. Sales is around about 2.3 million, and company is very efficient. Only four people are making this to happen. So what we will do is that we combine our same kind of division and this one, and start then improving the business and growing the business from there. So practically this means that now this division is then operating at the moment with some 400 units of small earth moving equipment in Finland. And of course the target is now to make a plan that we will clearly now start growing in this field of business. So this is very good strategic acquisition for us. Then next I would highlight two things from related with Germany and improvements in Germany. Acquisition of CS Raum Center. It's very I would say locally strong and good company, making revenue some 4 million in 2013, operating with some 900 units, not too many persons, 21 persons involved. It has long tradition, 30 years old, and very well known locally in this business in Germany, in Frankfurt area or Rhine-Main area. So they have their own way of and own products, modules, and we will now introduce with this platform also their, let's say, more high-class modular applications which we use in Nordic countries. This is a good start for really concentrating or growing and introducing us also as a modular rental company in the German market. And to support this, luckily, pretty much in the same time, we were able to secure one of the really good contracts, which is described here. The client is German energy company, TWL, and the project covers about 2,500 square meters. So the main building is in 3 stores. There are approximately 100 workstations, so this is a kind of office building combined with their existing offices. And this is strategically also very good project for us now to introduce us as a big supplier of big projects. The size of this project is actually such that it's substantial even comparing our projects here in Nordic countries. So these are good support to start really concentrating also in this line of business in Germany. Okay, here just as a summary, I would here highlight only our must-win battles. Martti mentioned that now it's time to renew the strategy or review the strategy, which will always bring some more things, not expected to change radically anything. But what we will go through and renew is our must-win battles. So far we have been able to make these must-win battles as tools to support to implement our strategy in practice, and I would emphasize in practice. They are really practical projects. So we have rolled out the Cramo rental concept quite largely already in the whole operation. We have implemented many different type of processes. ERP is now one which is almost one. Develop our people. And as I already mentioned before, very important practical project for us to implement performance management in the whole group. And it's not fully implemented, that work is ongoing. And profitable growth within modular space now expanding from Nordics also towards Central and Eastern Europe. So this work, of course, will continue, but I just wanted to remind here that these are really the backbone of our performance improvement in the future. Okay, what is left is to summarize of our messages here. Of course, the Ukrainian crisis has brought some uncertainty to growth expectation, but at the moment it seems that it's limited in Russian and Ukrainian areas. And as I disclosed earlier and commented, for the time being, the general expectation of economic revival in Europe remains unchanged. So growth is expected during this year and in the second half of the year. And in the long term, equipment rental market is expected to grow always faster than the construction market. So our guidance remains unchanged. So this with this results and presentation, we are ready to go forward with the performance improvement, and we are confident that next quarters will be much stronger than the first quarter. Okay, thank you for attention, and now please questions from audience here, if you have any. No questions? Are you sure? Okay. Was there questions from the web?
There's questions from Johannes Grasberger, Nordea. Why did EBITDA not improve year to year in Central Europe, although weather was mild and fleet utilization thus should have been better?
Yeah, that's an obvious question, and of course overall this was a little bit under our expectation. We were expecting slight improvement. Fact is that especially the March month was much easier than year before. That's clear. But the transition program which we are implementing, it's so big that it has caused quite much costs. That is something which is in the figures, and yeah, that's really the main thing. The other is, as I already commented earlier, that unfortunately it takes some time to ramp up totally new hubs, totally new depots, totally new products before it really generates you profit. But as we see that now the sales is coming in, so now it's to follow that the profits start to improve. Of course, it's unfortunate that in Q1 this was really not seen yet.
Yeah, and it is expected for Q2.
Sorry?
It is expected for Q2 to improve.
We don't give any guidance per quarter, but of course the aim is now to quarter by quarter to improve. So of course it's easy to compare our situation last year. Market as such is at least the same level, so of course we expect that now next quarters will be much better.
Okay. Do you have a timeline or any flavor on how to improve the fleet mix in Germany? Will something happen already in 2014?
Yeah, here I can only refer to the same comments. This is the main thing what we are implementing, and as we have disclosed in the previous quarters, that we have done now already big investments in access, some investments also in tools, and established 6 new access hubs, continuing to establish 5 more this year. But it's not so long time ago that the first one started to operate already. So that's why it's too early to expect so big impact. Of course, we would like to see the impact as soon as possible, but this is exactly what is now happening within transition.
I would like to add that within those hubs we have also established what we call a service organization of technicians, which we didn't have before, and that is also the reason why there is, in addition to salespeople, there are also more technical people. But we believe this is really essential also to differentiate on the market. We will be able to really, if there's a problem with the machines, to correct, and we have technicians going around compared, we have investigated on the markets. Several of our competitors do not have such a good service function. So this is also an investment towards the future.
Okay. Then another question. What does your customer mix look like in Sweden at the moment? Can you say what your exposure to northern Sweden is?
Unfortunately, this is a question which this information we have not available here. So of course there are big clients, one of the biggest LKAB, so mining sector has been important for us. But that is not the main thing why I commented that it was weaker now in the first quarter. Of course there were certain projects involved in some mining sector which were delayed, but generally there has been other sectors and projects which were weaker and fewer and delayed. Unfortunately, I cannot disclose any more specific figures here.
And then another question. Finland EBITDA was actually better year to year despite a weak construction market. Are you able to maintain such a lean cost base and hence defend the seasonally very good margin for this segment?
Yeah, I think I have commented now many times Finland as an example how we can do good business in a weak market situation, and where we have implemented almost fully all our strategic projects, meaning performance management, etc. We have implemented also maintenance and service follow-up more efficiently than in other countries. All these are now helping us here. So, well, yes, we believe that we are able to continue good profitability in Finland, even in this weak market situation.
Okay. And the last question for Mr. Grasberger. Do you think that the Polish construction market is stable in such a way that you could be a bigger player in that country?
Generally, yes, because it seems that now market is really in construction. It's picking up, and of course our aim is to be one of the major rental companies. We are not the biggest one, and not necessarily the biggest one, but we want to be profitable and most profitable. And with this outlook, we aim definitely to grow.
No more further questions.
No further there. Okay, is there now any questions from here? No. Okay, then it's time to thank you. Thank you very much.
Thank you.